All right, guys. Hey, welcome to our Wednesday product training call. Today's topic is mortgage protection. As you can tell, Janelle and I have been running a lot of mortgage protection. We're getting a lot of agents back into that because it's something that we know that works, right? Regardless if the data um, is there or not. Like, here's what was crazy. Like, when I was talking to Josh Crenshaw this past Monday, and he was like, when you said it on the call on Monday, it made me realize how like stupid we were, but at the same time, like that was our only business model. He goes, yeah, dude, we were paying $80 a lead, right? And on $80 a lead on $1,000 worth of ads, like we were getting 12 leads. You know what I mean? So like on 12 leads, you had to book appointments, get yourself in the door, close people you probably shouldn't have closed because you know at the end of the day, you have a lead bill coming out next week. So like we were always chasing this lead bill until we got ahead. The game of mortgage protection now is a lot different. Age mortgage protection, you can get them for $4, $5, $6, $7, $8 a lead, whatever it may be. If you're running IVR mortgage, like some of us are on this call, like your lead cost is maybe $20, $25 a lead. You know what I mean? Like it's a completely different game. You can get them all different parts of the country, and you're not obligated to run in the same area, which in my opinion, the competition is less because of that. Right. And so I wanted to do this call because I feel like a lot of people have been asking questions, right? You guys have seen me do some presentations, ask a lot of questions. Um, I want to make sure that I'm not knocking anything that anybody's doing, right? Like I love IULs. I think final expense is great, especially as a supplement in the morning when you can't call mortgage because they have jobs. But here's my argument that here's the reason why I think a lot of people should add a little bit of mortgage in their schedule. Number one, they get paid at least twice a month because most of them have jobs. So, like, how much are you going to future draft date? Very rarely, right? Like, I think the 6 or 7 policies I wrote on Zoom for all you guys to watch, none of them, not one of them, were future drafted. And a lot of people go, it's telesales, you got to do it. I debunk that myth. That's not true, right? Number two, they have jobs. So, like, instead of working with a budget where they only make $780 for the month, you're probably working with someone that has $6,000, $7,000 a month in income, right? A lot easier to sell a $80 to $100 a month policy to those clients. They have something bigger to lose. They're home, right? The need is definitely there, especially if it's a husband passing it on to spouse and kids, or it's a parent leaving it to their children. Like there's definitely a need there. And so I like this lead type for that reason. You know what I mean? So I know we're gonna have a lot of questions, and feel free to ask. So like, I'm gonna go through the basics of what I want to cover here, and if y'all have any questions, just drop them in the chat, and I'm gonna go through them because this is more like I want to have a conversation with you instead of sitting in front of a camera and just like train on mortgage protection. Um, Number one, everybody goes, "What's your script?" This is my script. If you don't use a financial inventory, I don't know how to help you. I'm not trying to be rude. I don't care if you have your own financial inventory, but this is my script. This is how I'll bring the need out in an appointment. This is where I can follow a guideline and literally grab all the information that I need. So, like, we're going to start with this top half right here, mortgage info. So, when I get on the phone, like, let's say I'm an appointment with Barbara, I'm going to go, hey, Barbara, this is Steven. We had a 3 o'clock appointment for mortgage protection. Is now still a good time? If she says yes, I go, perfect. Do you receive text messages on this phone? She says yes. I shoot her my agent validation page. I go, all right, if you click that link, it's a picture of me. If you scroll down to the part where it says California, click the button. That's my state license. Basically lets you know that I am licensed to do this, not just in California, but for me, I have all 50 licenses, so in all 50 states. And all that basically means that I pass a lot of background checks to be able to do this. Cool. And she goes, awesome. And then I go, so basically my job is real simple. I'm going to ask you some questions regarding your health and finance and your mortgage. Send it to the 30 different insurance companies we work with. They're going to give me 2 to 3 best plans. I'm going to explain to you what I like best for you. All right. And if you like it, we'll help you apply. If you don't, we'll be done very quickly. Right. And then I jump right into this. And so if I have their mortgage amount, I'm going to go, hey, Barbara. So like the loan balance I see is 320,000. Is that correct? And it might, and by the way, let me do this right here. Like sometimes the loan balance is $321,962. I'm not saying that. Me personally, I'm gonna round up. I'm gonna go, hey, it's about 320 grand. Is that right? Yes. Cool. Next question, home value. What was your house appraised at the time of close? Now, here's the thing I'm going to tell you about mortgage protection. You want to use mortgage lingo. So, like in the mortgage lingo, in the real estate lingo, people get their houses appraised when they usually try to pull money out or they have to, get a loan or whatever it may be, right? So, hey, what was your house appraised at the time of close? Oh, it was appraised at 500,000. Okay, cool. So, that's about 100 and, $80,000 worth of equity, give or take, right? And I write that in equity. And then I go, what's your monthly mortgage payments like? And they give me that number, right? And I was like, is this a purchase or a refinance? This was a purchase. Cool, man. Was it your first one? It is. Hey, congratulations, man. Being a first time homeowner is awesome. Not a lot of people in America can do it, right? If it's a refinance, great. I'm assuming you were doing it to save money because that's the only reason why most people refinance, right? Either take money out of their home or save money on their payment, right? Awesome. How long was that loan for? 20 years, 30 years? Usually it's 30, right? What was your interest rate? Right now, right? 6, 7. Wow. That's better than the other client that I spoke with prior to you. That's probably me telling a white lie. But dude, nobody wants to hear that they got the highest interest rate, right? Hey man, do you make any extra payments on your loan? Yes, no. Why? Because I'm going to be able to use that against them in a near future. So everything on this sheet is on there for a reason. We don't ask questions just to ask questions. Does that make sense? We ask questions because we know we're going to need it. So, for example, if someone tells me they make extra payments on their loan, later on in the presentation, I'm going to go, dude, you're basically paying down the house for the bank to take it more later. Like that's what we're going to talk about. You know what I mean? So, on the very bottom left, where it says loan, title, and trust, okay? Loan, I don't even know if I can highlight it. Yeah, I can. Right here. This is where my sale is made. This is where my sale is made. I'm going to explain this to you until I'm blue in the face. Okay. Parza asks a great question. He goes, what if they don't know the value of their home? Great question. Go to Zillow, go to Redfin. If the estimate, what number they give is higher, take that one. Meaning, if they go, I don't know the value of my home, and you go to Zillow and you go, hey, it says 500. They go, that sounds about right. Then I go, cool. If they go, nah, man, it's definitely more than 500. It's 520. Guess what, Parza? I'm going to use what they tell me because the more the home value is, the more they got to lose. And by the way, Zillow and Redfin doesn't know what people actually do in their homes. Like I put a pool in my backyard, right? Zillow don't know that. So, but I increased the value of our home, but they don't know that, right? So trust people, right? And usually what they say, or take the larger of the two in numbers. So let me dive into this part right here. Loan, title, and trust. This is where my sale is made. I'm going to repeat that like 10 times because I don't think most people understand the legal process of what happens to a house when someone dies. I'm going to say that again. I don't think people know what actually happens legally to someone's house when you die. The amount of times that you guys have seen me run mortgage protection appointments and I go, hey, Bob, hey, Mary, who owns this house? For those of you that have heard me say this many, many, many times, 90% of the times they go, we do, I do. And they say it confidently. They go, like Barbara, I go, hey, who owns this home? And you're like, I do, right? Like confidently. And I'm like, no, you don't. And they're like, what? I'm like, US Bank, Rocket Mortgage, Caliber, whoever your lender is, they own your home. And they're like, what do you mean? I'm like, because you make payments to them every month. You don't make payments on things you own, right? Like I own my iPhone. I don't make payments on there. I don't make payments to Apple or Verizon or whoever I use my carrier is. Does that make sense? So like right here, I have to establish the why. The why is, bro, this ain't your home. Matter of fact, you rent from the lender. That's a very mean way to say it, but it's true. Now, I tell people the reason why you bought a home, though, is because over the course of the long years, right? 10, 15, 20 years, houses usually make money. They do. They appreciate in value. There's equity compared to renting. Facts, right? And I tell people if you didn't actually care about your home, why don't you just rent? Right? But it's because the equity aspect of the home is what we're going to hit on. So I go, Bob, Mary, who's on the loan? And this is magic right here, by the way. Like what I'm going to tell you right now. Because no matter what they say, I win. So if let's say Bob and Mary are married together, right? Tongue twister. Bob and Mary are married. Okay. I go, Bob, who's on the loan? He goes, just me. I go, huh, got it. So you're very unique. You're a primary income earner. You're a primary breadwinner, right? Meaning you're probably making a six-figure income. Mary's probably a homemaker taking care of the kids, right? Because when we go through the financial inventory right here, we're going to find that out, correct? But if I go, hey, Bob, are you a prime? Who's on the loan? He goes, just me. I go, perfect. Because in my mind, when he dies, Mary can't get the home. She can't refinance. She doesn't have an income source. Does that make sense? Because if she could have, she would have been on the loan, but she's not because she doesn't have any income. They just sold themselves insurance right there without them knowing. Now, here's what's interesting. Let's say I go, Bob, Mary, who's on the loan? They go, we both are. Right? They go, we both are. I'm like, oh, you're like 80% Americans, two income household. You need each other's income to qualify for the home, correct? Yes. They tell you proudly, yes. And I go, exactly. So that means if either one of you died, the other one wouldn't be able to make it. That's the reason why you're a two income household. So whatever they say, we win in this appointment. We have to understand that. Okay. Now, the next question is who's on the title? Let me explain to you what this means. When you buy a home, there's a stupid letter. Some people call it a title. Some people call it a deed. It's basically the same thing. Basically means who owns this, who has the rights to this home. Not who owns the home, who has the rights to this home. Let me give you some free knowledge for you agents on here. Most lenders are lazy as shit. Right? Like Janelle and I think we've purchased 5 homes in the last couple of years. She has never signed for the title. They've never asked her to. And every time I ask, I go, hey, I want my wife on the title. You know what they say? No bullshit. This is what they say. They go, it's going to delay the signing process and the recording. So instead, what happens is let's just get you the docs now, and then you can go to the county recorder's office and get her on there later. They minimize it. They downplay it. But let me tell you why that's dangerous. Because nowhere on there does it say I'm leaving the house to Janelle. And so 80 to 90% of your clients, that is true too. That they're not, their spouse, their children are not on the title. And then the third question is, do you have the house in a trust? I want to say less than 5% of my clients even know what that means, let alone has it. The majority of the time, the question that I get back is, what's a trust? Okay, so let me explain to you as agents what this means. A trust is a living trust is an entity, right? So it's an entity. It's not a person. And a trust cannot die because it's not a person. People die, yeah? A trust doesn't die. It's not possible. So wealthy people and smart people put their title, the one in the middle, the title of the property is the trust because it can't die. Y'all ever heard of the word trust fund babies? Right? Where does that word come from? Trust fund. That means their parents put all their assets in a trust. So it gets to skip probate when they die. Now let's dive deeper into that. Why the hell would someone want to put their house, the title of their home, inside of a trust? Because you can't pass this on to your family any other way. I love it when I meet with clients. I go, Bob, Mary, what's going to happen with this house when you pass away? Oh, it's going to go to my kids. I go, but you don't have a trust in place. Show me how. Tell me where. Does it say it's going to go to your kids? Well, it's my house. No, it's not. It's US Bank's house. You just make payments to them. Right. And they're like, well, but it's my house. It's not your house, dude. You don't make payments on things you own, bro. I don't think you understand that. Well, well, how do I make it go to my kids? I'm like, exactly. There's no legal document. I run a joke. Some of you guys have heard me say this. I go, dude, I try to call T-Mobile to make changes on my phone bill, but my wife's the account holder. T-Mobile won't even let me make changes to a phone bill because I'm not on there, let alone a house that's worth a couple $100,000. Are you kidding me? Right? So, like, how do you think your kids are going to make calls on your behalf when you're not here? And then I tell this story. I go, all right, true. By the way, this is a true story. 2019, my wife and I buy a home because we were expecting baby girl on the way. And because I'm selling insurance, just like every single one of you, I think that year I did like $140,000. 1099 though, right? Because I got paid from the carriers. Well, here's what's crazy. The insurance carrier, okay, pay us 1099, which is an amazing income. But if you guys ever ran mortgage protection, most of your clients make 40, $50,000 a year, right? But they're on W-2. So because they're on W-2, the lender gave them a loan, no problem. But because we're 1099, they go, your income is too unstable. We can't trust it. Right. So my mom had a co-sign on my loan because my mom is my mom and she wanted to help out her son. Right. So we do this. And in 2022 or 2021, we moved to Vegas. Right. And we left our house behind. And then what happened was my mom was diagnosed with cancer. And in December, she passed away. So now I'm like, I'm out of California. I hate California. Don't want to have anything to do with California. Sell the house. At the time, we probably had like 200,000 of equity in the home, probably give or take, right? And I'm like, sell the house, get out of it. We're done, right? We find a realtor. We list the house. Title company runs a title check and goes, you can't sell the house. And I'm like, why? They're like, because your mom can't sign the bill of sale. By the way, I'm an only child. There is no one else to fight in court. Like there's families that will fight in court for their parents' belongings. I don't have another sibling, bro. Not even a step sibling, right? So they're like, we'll see you in court. I was in court for 26 months. We went through, what was it, babe? Like 23 attorneys, something like that. Spent like $60,000 to retain a property that was mine anyways. My mom had 1% ownership on my home. Not half, not 20, one. So the house was worth 600,000. She has 1%, which is $6,000. I would have literally paid them to get it done. They're like, no, I don't work that way. So we're in court. 2 years, 2.5 years. And people go, why was it so long? By the way, you can't pay an expedition fee. You can't. It don't work that way. You want to know why it takes that long? Alice? You want to know why it takes that long? Because there's that many people that were in the same situation as me, that their parents died, their spouses died, whatever it is, and now they're tied up in court because they can't move the assets. 26 months. So now when you tell your clients this, They go, what? And I go, yeah, you want to put your kids through that? By the way, while you're going through probate, you have to make the mortgage payments because at any given time you miss your mortgage payments, they just take your house, right? So this is where the sale is made. The sale is literally made right here in those three questions. Here's the other crazy part. Here's a free tip. If your clients are over the age of 60, I think you should sell them every time. A lot of agents are scared of those sales, right? They're scared of those sales because the clients are older, have like 400,000 in mortgage. You can only really sell them final expense, right? Let me tell you why this is important. I go, hey, Bob, you're 63 years old. You just refinanced your loan. They're like, yeah. I'm like, how long was the loan for? They're like 30 years. And they say it proudly. You know why they take a 30-year loan? Because the longer they stretch it out, the cheaper it is, right? So they have a 30-year loan. I'm like, you're 62 with a 30-year loan. You know what that means? You'll be 92 when you pay it off. Hey, Bob, newsflash. You ain't making it to 92, bro. But you want to know why the bank gave you a 30-year loan at 62, at 74? Because they know that right now you'll be fine making payments. But when you die, someone in your family is going to fuck it up. And then they're going to be able to scoop your house up because you're going to mess it up and they're going to short sell your property and they're going to take your equity. That's the reason why. Because think about it, Danny, like Danny, for real, a 72-year-old with a 30-year loan? Really? The math don't make sense, but they do it. Write this down. This is another phrase that I say often. I say the bank always wins no matter what. Mary, Bob, the bank always wins no matter what. And they're like, what do you mean? I go, number one, you make the mortgage payments on time every month. Guess what? They make the interest payments. For those of you that have never had a chance to see a loan, you know what? Let me do it right now. I'll pull it up for y'all to see. Amortization schedule. Okay, this is what a home loan looks like, by the way. So let's pretend this is a $330,000 loan, 30 years, 5.27%, which is not possible, but let's just say it is. If we click schedule, this person's $1,800 a month. Dude, 1,400 of it is going to interest and only $300 is going toward principal. You know what that means? They're paying the bank first. By the way, for those of you that have never bought a home or don't understand this, on a $330,000 loan, you'll pay $650,000 for that home at a 5% interest. And you're like, what do you mean? The house is $330,000. No, 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 no. The bank always wins, bro. The bank's gonna make their interest payments first. Does that kind of make sense? So, like, I always tell them, the bank's gonna win because you make your mortgage payments. You default on the loan, they're gonna foreclose your home, short sell it. They keep your equity. They win. The bank always wins. So I go, Bob and Mary, it's not that the bank will win in this case or not. I just got to make sure your family doesn't lose. You're not going to beat the bank. The game is rigged. Let's be very clear. The goal is to make sure that you don't lose. Does that make sense? All right. There's a bunch of questions in the chat. Let me go through some of them right now. Damn, our chat is popping today. Is a trust and a will the same thing? Absolutely not. A will is free and cheap for a reason because it doesn't do shit in court. That's why trust costs $500 to $2,000, maybe even more, depending on how many assets you have. So a living trust will keep your house away from probate. A will won't do anything. You can't deed a property to a will, anyways. How would you start the call when calling age mortgage leads? Janelle has a script, Joy. If you ask her for it, she'll send it to you. It works phenomenal. Um, how can you make it important to have mortgage protection opposed to having a living trust? No, no, no. That's not the case. The case is you need to have both. I'll explain to you why. Um, boom, boom, boom. This is a stupid question, but if someone is 3 to 4 years, give or take, from paying their house off, would you bother trying to make a mortgage protection sale on them? Absolutely, because you don't know when you're going to die unless you get to play God, right, Barbara? Um, and at the end of the day, it's just life insurance. So I think everybody should have life insurance. That's why we have a license, right? Is there a deed that has rights of survivorship? So when one party dies, the other party automatically inherits the share without having to go to probate? Great question, Arnie. So going back to this, this is where the educational piece. Remember, we said this is where the sale is made. This is where the sale is made. This is where the sale is made. So I tell clients, I go, hey, there's two ways to skip probate. The first way, the smart way, is to put the house in a trust, but it costs money. It costs you $500 to $2,000 depending on how many assets you have. Okay. And I tell the client, I go, Bob, I don't even sell trusts. So I can't even sell that to you. I'm just giving you free education so your family don't end up like me. Okay. The second way is they can go to the county recorder's office. Write that down. County recorder's office. And they can do something called a quit claim deed. Quit, Quit, like you quit something. Claim, like I'm claiming a reward. Quit claim deed. Quit claim is one word. Okay. A quit claim deed basically says when I die, this person gets my rights to the home. And that costs maybe a few $100. But here's the craziest part. They never do it. Does that make sense? They still don't do it. So I tell people, even if you have a quit claim deed, even if you have the house in a trust, guess what you still have? You still have a loan. See, a house has two enemies. Probate is one, the lender is the other. Okay. So, like, yeah, you can have a trust to bypass probate, which is awesome. You should do it every time. Part two is you still have the loan, though. You still got to pay them because the house is not paid for yet. Does that make sense? So hopefully that makes sense. Ethos comes with a will and trust. Yep, absolutely. Does a trust expire? No, it does not. Does it need to get paid annually like a license? No, it does not. Elisa says, I do living trust, and I can tell you there are so many things that come down with owning a home, not just death. What if they get disabled, suffered an illness? Oh my gosh, thank you, Elisa. Yeah. Advanced healthcare directives, all that stuff. Absolutely. Absolutely. Every part of that is true. So let's go back to this appointment now. Okay. So who owns the property? The bank owns the property. The bank always wins. Okay. Prevent the house from probate. Okay. So let me give you a scenario. You have a parent in their 60s and 70s. They might be widowed. They might be divorced. Hey, Bob, who are you leaving this house to? I'm leaving this house to my son, John. Cool. How? Where? Does John live with you? If John lives with you, it's going to be even more fun. If John doesn't live with you, it doesn't matter. He has to take care of 2 mortgage payments. He has to move your things out of the house to sell the house. Then he has to stage it, find a realtor, list it. What happens if it's a bad market? Do you want to sell the house when the market is down? Do you want to sell the house when the market is up? You see what I mean? There's too many scenarios for this client, right? Um, so we're good, kind of under that. Okay. Next thing I want to move on to, I want you to understand the insurances in a home. Okay. So there's 3 insurances on a home traditionally. The first one is something called PMI. PMI stands for private mortgage insurance. They don't have a choice to pay this or not if they don't have 20% of the house down. Meaning the house is a $500,000 and they don't down payment 100,000, automatically the bank puts this on there. Danny, they don't get a say. It's automatically on there. And what does PMI do? It protects the bank. That if Bob messes up and defaults on the loan, the bank gets the home. Your client is paying for this, whether they want to or not, unless they have 20% of the house paid, which most people in America don't. So when your clients go, I already have it, that's usually what they're talking about, by the way. Yeah, exactly. 70% of people don't even know what that means. Okay. So the first thing that they have is something called PMI. The second thing is called homeowners insurance. What is homeowners insurance? Homeowners insurance covers the structure of the home, the walls, the ceiling, the foundation, right? It covers the stuff in the home, the jewelry, the assets. Okay. So like, here's what I tell people. PMI covers the bank. Homeowners covers the home, even though they call it homeowners, which is really interesting. Covers the home. Mortgage protection covers the people that live in the home and the people that pay for the home. And in my opinion, the most important person in the home, because y'all the one that pay the mortgage. So I go, isn't it crazy that it's a requirement for you to have PMI and homeowners, but not to cover yourself? You know what I mean? So when we get into the appointment and they go, what is this again? What are you calling me about? This is where I go into. I go, great question. Most people are not aware. By the way, is this your first home? It is. Congratulations, by the way. But there's three things in a loan. I have three things on an insurance policy on a home. First one's PMI. Second one's homeowners. Third one is this. Let me ask you a question. If something were to happen to you, would your spouse be able to live it? Blah, 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 blah. Got it. That's the reason why I'm here today. Because a lot of times they think they already pay for this. No, they don't. Here's another great one. Is this required? Is this mandatory? No, but it should be. That's what I tell people. No, but it should be. Car insurance is not required because you can technically drive a car without car insurance. Be a bad idea, though, when you get in a car accident, right? Health insurance is not required. Bad idea if you get sick. You know what I mean? Is mortgage protection required? No, but it should be, just like those other two. Right? Um, here's something that I get when you go through the financial inventory, and I ask them, "Hey, man, do you have any private life insurance policies?" Okay, because a lot of new agents trip over this. I think my wife sometimes struggles with this too. That's why I'm kind of going over it. Do you have any life insurance, private life insurance? And they go, yeah, I have something through work, right? TJ, they go, I got something through work. I go, let me guess. It's like 3, 5, or 7 times your income. Yeah. How do you know that? Dude, I do this for a living, bro. It's great while you work there, but it's not really good after that. Right. And I downplay that. But what do you have on the private sector? What do you have on the private sector? Oh, a friend of mine sold me this, or I bought this from AAA or Allstate or whatever it is. Right. I go, great. I would write this next saying down. Life insurance is usually used for income replacement. Mortgage protection is to protect the home. Once the house is paid off, you still have utilities and property taxes that come in when the house is paid off. That's what your life insurance is for. Most of my clients that have mortgage protection already have a life insurance policy. They go hand in hand. That's how you kill the life insurance objection. Cool. Is this helping you? Hopefully. Okay. Colton asked a great question. Can you explain how you sell early payoff, especially if they're paying extra on the mortgage payments? Great question. So like we talked earlier, Some people make an extra payment a year. Okay. And like if you do mortgage protection, you got to understand when they usually make that. So like usually people make that extra payment a year after they get a tax refund. Like usually. So like if people go, I go, hey, do you make extra payments a year? They go, yeah, when I get a chance to. And my answer is, let me guess, when you get a tax refund at the end of the year, they're like, yeah, because that's what most people do. Okay. So like you got to know that. All right. Second thing, a lot of people make an extra 300 bucks on top of their mortgage every single month. So if their mortgage is 2,500, 3 grand, they make 2,700, 3,200, 3,300. They make an extra 200 to 300 bucks every month. Why do they do this? They do this because they can pay off their house earlier. Usually, write this down. They usually can pay off their house 3 to 7 years early, depending on how disciplined they make that payment and how much they actually make. Now, let me tell you why this is stupid. Okay. Because in traditional finance, they go, you should pay off the house early because you can save a lot of money on interest payments because the banks always win, right? We already know that. Let me tell you why this is stupid. I know I'm like a walking contradictory, right? So I go, hey, Bob, check this out. Your mortgage is 2,500. You make an extra 200 bucks a month. Okay. In a course of a year, that's $2,400. In a course of 2 years, $4,800. You die in 2 years. What happens to the house? Instead of owing 350,000, you now owe 340,000. You paid the house down, but you're dead. Your wife, your kids still have to make the payments. What did it really do for you? See, paying off your house and making extra payments only matter if you live. Does that make sense? And I go, but here's the best part about mortgage protection. By the way, this is why I love IULs. Because an IUL, you don't have to wait all the way through to the end of the term to get the cash back. Does that make sense? Like if you sell CBO, you get the money back at the end of the duration. You can't cancel in year 17 and get the money back. In an IUL, there's cash surrender throughout the policy, correct? Yes. Cool. So that's why I like IULs. That's why you guys see me pitch American IULs frequently in this sale. I go, but the beauty of it is if you take that 200 bucks that you send to the bank anyways, and you reallocate that money into the insurance policy, in year 23, 25, 27, you have enough cash in your insurance policy, your mortgage protection policy, to pay off the house anyways. And if you were to die anywhere in between, they would pay off the whole house or pay off a large portion of the house. I go, so when you give it to the insurance company, it does two things. It can pay off the house when you die. It will still pay off the interest. You give the money to the bank, it only pays the interest. This is why I think if you make extra payments on your loan, I think you're stupid. And I tell my clients that. Right? Because if I go, Amin, you make an extra $200 a month. You took your balance down. You pass away. Now Jamie has a balance. What now? But we make $200 a month to an insurance policy. Amin lives. Guess what? In 25 years, 23 years, 27 years, pays off the house. He does what he wants to do with the policy anyways. That's what the money was supposed to be meant for. He's reallocating the money to the insurance product. But if Amin makes 2 years worth of mortgage payments, mortgage protection insurance payments, 200 bucks, 4,800, dies. Boom, here you go. Jamie, here's a check for 250 grand or whatever it is. That's a better return on your investment. Does that make sense? So Colton, I think that's what you were asking for, but this is why they're fun. This is not your traditional final expense appointment. And if you understand all these things, it's a very easy sale. You know what I mean? Let me go through some of the questions. Sorry, I might be going over on this call because we're talking a lot and there's a lot of stuff on the notes. Yep, I agree with the launch. This is why my favorite selling mortgage protection, because we actually get to educate people on what the hell happens to their home. Pull up an amortization schedule, freak them the hell out. Which product would you go for mortgage protection? I use IUL because the IUL is cheaper than CBO. And not only that, they get to surrender the cash early if they wanted to, and the money is there, you know? And an IUL returns better than one to one. So what that means is like with cashback option, they would have to put in 25,000 to get 25,000 back. In an IUL, they can put in 25,000, but with the market indexes and all that, they can get $40,000 back. You know what I mean? So like they actually make money on it, which is really, really awesome. Um, Arnie, I don't sell CBOs anymore. There's no reason to, especially since we have the IUL product because it generates cash at a faster clip. And as I said, it's not a one-to-one return. It's a lot higher with an IUL, right? So, boom, boom, boom. Kill life insurance plans, types of loans, bank versus you, one-leggers. Oh, here's a great one. Y'all ever run appointments and like you have like the stubborn husband or even the wife? Sometimes it's the wife too. I ain't gonna pretend, right? You have the stubborn person. I make all the decisions. I don't need to talk to my wife. I make all the decisions, right? I talked to a lady the other day. My husband just does what I say. Absolutely. I believe that the way you're talking to me. You know what I mean? But how do I get past the one legger in mortgage protection appointments? Okay. There are 9 states in the United States that have something called community property. And what that basically means is the husband's debts when he dies goes to his wife. The wife's debts go to the husband because y'all are married, right? So I go, hey, Mary, hey, Bob, as much as I want to do the presentation for you, and I know that your wife is going to make the same decision you pick anyways, I can't do it because in California, it's a community property state. So I'm required to talk to the both of you. And they go, damn, that makes sense. And they will get their spouse or I reschedule them. Does that kind of make sense? So that's how I get through one-leggers. If they're married, correct. If they're married, Daniel. So like, just so you guys know, I want to explain this to you, just so you guys can understand. In America, debts pass spouse to spouse. Debts don't pass parent to children. Does that make sense? So like my mom owned a business, has her own stuff. She passed, let's say she passed with debt. The creditors, the lenders can't come to me and go, you got to pay your mom's debt. They can't do that. Okay. But Janelle and I, we're married. I die. Let's say I got a crap ton of credit card loans and business loans and all kinds of loans. And right. Guess what? Because we're married, it's her debt too. That's how it works. So debts transfer. So what is a mortgage? A mortgage loan is debt, which is why when they go, I want to leave it to my kids, I'm like, how? Okay. Here's another one. I want to go back to this a little bit. Um, this is the angle that I take. So we sell a lot of critical time period. We go, hey, you know, Bob is, you know, an insurance agent, makes 6 figures, Mary's stay-at-home mom, homemaker, takes care of 2 kids, right? And I go, hey, Bob, I talked to Mary. I go, Mary, Bob dies. What are you doing with the home? She usually doesn't have an answer. This is where I chuck a ton of things at him. I go, because I've been doing this for a long time, Mary, Bob. Like I'm usually able to predict all your answers except for this one. So let me explain what that means. When someone dies, here's like the 6 to 10 options that can happen. Number one, they can stay in the house because that's where they grew up with their family and they're never going to leave. The second thing is they're going to sell the house because every room they walk into, they're reminded of your spouse and they don't want to go through that mental pain. The third thing is they might move in with their kids. The fourth thing is they might hate their kids and don't want to move in with them. The fifth one is they might have their in-laws move in with them. The sixth one is they might not want their in-laws with them. Not too close, right? Seventh one, they might rent the house out. Eighth one, ninth one, they might sell the house, take the equity, downsize, keep the rest of the money on cash. So let me ask you this question, Mary, which one are you going to do? And she goes, I go, exactly. Bob, do you understand why this is important? Because when you die, Bob, we got to give Mary enough time to figure out what's best for her. But if you don't have this plan in place, she's obligated to make a decision and it might be a bad decision. Write this down. I say this in every one of my appointments. I go, because Bob, you and I both know that when you make permanent decisions on temporary emotions, they're usually bad decisions, right? And so I draw that process out. I want to leave the house to my kids. Cool. Do they live with you? Do they live close by? Do they live out of state? Oh, they live out of state. Got it. So when you die, they got to fly in, which costs money. They got to take all your belongings, the ones that they can actually hold on to. The ones they can't, they got to put it into storage, which costs money. They got to clean the house, which costs money. Take time away from work to get this taken care of, which costs them money. They got to find a realtor, stage the property, and then sell the house, which takes time. And they can do this all while burying you and grieving at the same time. This is why we need to buy them time, Bob. Because wouldn't you agree, it'd be very, very foolish to lose $150,000, $200,000 worth of equity because you didn't spend $100 to protect 6 months, 9 months of the mortgage for your family to grieve. Brenda, the line was, you don't make permanent decisions on temporary emotions. Arnie asked a great question. He goes, what are the best rebuttals for I need to think about it? Great question. So I make everything in a mortgage protection appointment like them getting a loan. I go, hey, Arnie, so before you can even think about it, the insurance company has to think about you, just like when you got a home, right? So before you can go house shopping, you need to get a pre-approval letter from your lender. For those of you that purchased a home before, you know that is true, right? So just so everybody on this call is aware, if you've never bought a home before, like you can't just go walk into a house and go, I want to buy it. You have to get a letter from the lender that says you can afford this amount. Does that make sense? So like, how do they give you that letter? Well, they run your credit, they run your debt to income ratio, right? Make sure you actually have the money before you can go actually shop for that home. So I tell the client the same thing. I go, hey man, it's very similar to when you get a loan. The insurance company has to do a pre-approval for you too. Now, instead of pulling your credit and doing a debt check, what they do is they do 3 different databases. The first database is something called the Medical Information Bureau. They're going to look at any life and health insurance applications you've ever had in the past, any major doctors and hospitalizations. They're going to see all that. The second thing they're going to do is they're going to use your social to pull up your prescription database to see any medications that you have. Because as you can imagine, Bob, they wouldn't prescribe you metformin if you were not diabetic. It wouldn't make any sense, right? Okay. And then the third thing is they're going to check your motor vehicle report. They're going to look to see if you have any DUIs or reckless drivings. So once you clear all that, then you'll get a pre-approval. So like before you can even think about it, Arnie, the insurance company has to think about you. So we're going to see what's on the application that will prevent you from getting qualified. And then I just move it forward. And they go, well, how long is this plan good for? I go, dude, just like with mortgages, you know how like interest rates change on a daily basis? Yeah. Cost of insurance changes too, and usually not for the better. So I can't promise you that the price that we have today is going to be the one that you're going to be locked into unless you actually submit an application to make sure it goes through. Because if you guys know anything about buying a house, there's something called locking the rate, right? So like the interest rate right now might be a 6, but it might go higher. And if you wait an extra day or two and it's higher, your mortgage payment just went up. But it also might go lower. And if you locked it, you can't go down. So what a lot of people do is they lock in their rate. I use the same thing when I sell mortgage. I go, dude, we don't know if the cost of insurance is going to go up or not. So we just got to make sure you get a lock. You see how I'm saying that you got to parallel this appointment to them getting their loan. Sylvia, yes, this will definitely be up on YouTube. Absolutely. Do you go through the whole app or just run a pre-check? I try to go through the whole app, mm, most of the time. Yeah. Oh, here's a good one. Write this down. After I show options, option one, two, three, write this down. I go, hey, Bob, four things I need you to write down. Number one, this is portable and transferable. I did not know how important it was this for me to say this line, by the way. Like I knew it was always there, but I would never say it. And then I realized like Amy Michelson says it all the time. And I'm like, dude, she was the number one producer for a reason. Number one, Bob, Mary, this is portable and transferable. What does that mean? You're obviously 42 years old right now. You might live in this house forever. Most people don't. Most people live in three homes before they die. So when you buy your next house in 12 or 15 years from now, the insurance is going to cost a lot more because you're older. But these policies are transferable. They're portable, meaning if you got rid of this house, you don't have to cancel it and get a new one. The amount of people that go, really? And I'm like, oh, I suck at my job. Like by the way, you don't understand the amount of cancellations I had because people were like, I sold my house. I got a refi. I thought I had to do it again. Oh, my bad. I botched that. That's me. I take full responsibility. So I go, it's portable and transferable. What that means is that when you get this policy, and let's say you sell the house or move into an apartment and you no longer have mortgage protection, guess what? It it converts to a life insurance. It is a life insurance. It converts to a traditional life insurance policy for you. Number two, this is permanent coverage. It will never change. So it doesn't matter if you die at 42, 52, 62, 82, 102, it's going to pay out. Number three, price will never go up. Number four, price will never go down. Yo, this last one, this fifth one, I thought it was self-explanatory too. I'm going to tell you, this is why I know I suck at selling insurance. I need to get better. I'm like, at number five, Bob, Mary, it's tax-free. So like if you pick the $300,000 coverage option, like Mary's actually going to get 300,000 because you live in the state of California where the taxes are like the second highest in the entire country. So like instead of getting a check for only 240, like she's going to get a check for all 300. And people go, "Wow, that's amazing." And I'm like, I suck at selling insurance. I hit those five things before I make them choose an option. Portable, transferable. Number two is permanent option. Price never goes up. Coverage never goes down. Tax-free death benefit. And then I make them pick. It's crazy. Okay. Here's another thing you can use. If people go, how'd you get my information? Or if they go, how much time do I have to think about it? Okay. You ready for this? Great angle. I go, hey, Bob. So the way it works is when you buy your house, when you sign, right? When you sign the escrow docs, your your loan officer says they need a record today. What does that mean? They take those like 1,000 pages and they scan them and they take them to the court or the county and they record your loan. That's why the changes. Remember, we talked about how do you change the title? You had to go to the county recorder's office. That's the only place you can change it, right? Why? Because they have to literally go to the county. Because when you buy a home, it goes to the county, right? So, Mary, when you buy a home and your loan records, it goes to the county. The county sends us the information. We mail you a bunch of cards. I don't get your information without you sending something back, whether through a phone call or a piece of mail. And I go, by the way, mortgage protection is only offered when you purchase a home or refinance or get a HELOC. Anything new that happens to your loan, it will trigger an alert at the county and this process starts all over again. So like your neighbor that's been living in his house for the last 7 years, he doesn't get this option because he's lived in his house for 7 years. He's not going to get a mailer in the mail. You will. You'll probably get like 15 of them, right? That's how I create like the exclusivity. Maybe I missed it. So we're not, no, Arnie. The IUL policies perform so much better than the ROP policies. There's a reason why we stopped pushing cashback option, return of premium with mortgage protection. Underwriting is the same. Underwriting requirements are the same, but they have way more flexibility in their IUL, meaning they can access the cash a lot quicker. It is also permanent. So, like one of the biggest knocks that we used to have when we sold CBO or return of premium, whatever you want to call it, was they go, what happens after the 25 years, after 30 years? We go, you don't have any more coverage. They go, well, that sucks. I know. But it was just to pay for the house, right? So, right. But now we don't have to do that. We go, hey, it can be permanent. And if you want to draw the cash, you can and still keep the policy. You know, what happens if they don't get approved for an IUL? Most people don't, Sylvia, which is why we sell final expense very often in a mortgage protection appointment, right? We use what Janelle just said, senior mortgage appointment. We use a critical time period. We use equity protection. So, hey, I'm running over time. I can keep going if y'all are fine with it. I just don't want to, you know, I don't want to talk too damn much. But Arthur asked the same thing, critical time period. I'll give you a crazy story. Matter of fact, it was one of Arthur's agents. He's running an appointment in San Francisco, Bay Area, like Alameda. Like houses are ridiculous, right? He's texting me. He's like, yo, this client won't, they just don't want the angle for critical time period, right? And I'm like, that's not true. I just think you're an incompetent agent, but that's fine. So I'm like, call me. So I'm talking to the lady. I think her name is Desiree. I forgot. It's been a minute. And I was like, hey, Desiree. And she's 70, in her 70s, by the way. I go, Desiree, so how much is on the loan? She's like, 300,000. I was like, okay, cool. What's your house worth? 1.2 million. She has $900,000 of equity in this home. I go, okay, cool. So who's on the loan? She's like, just me, honey. I was like, who's on the title? Just me, baby. Who? Do you have a house in a trust? No, I do not. I go, great. So what happens is, who are you leaving this to when you pass away? She's like, my daughters. They live here with me. I go, got it. Do they contribute to the mortgage? No, they don't. God forbid something happened to you. Would they be able to contribute to the mortgage? They can't. Perfect. So what we're going to do is we're going to buy enough time, Desiree, that when the time comes that you pass away, it's going to give your daughters just enough time to sell the house and take the equity out. Okay. So the $900,000 that she has in this home, because her house is worth 1.2, but she has a balance of 300,000, right? So that means she has $900,000 worth of equity. Parza, there's only three ways you can access equity in a home. You either sell it, refinance, or you get a home equity line of credit. Well, they can't get a home equity line of credit because they don't make enough money to. They can't refinance it because they can't qualify for a new loan. So what's the only way they can get the money out of the house? Sell it. Right? So I said, this is what you need to do. Get a quit claim deed to your daughters at the time of death. Get it now. When you pass, they got to buy just enough time to be able to sell the house, take the equity. They can take the $900,000 right now, split it in half. That's $450,000 each for every one of them. I'm like, that's bigger than any life insurance policy you can give them. I'm like, option number one, 12 months, $250 coverage. It was like a 30,000 FE policy. Option number two, 9 months, 175. Option number three, 6 months, $15,000 policy, $160 or whatever. I go, Desiree, out of the three options that I showed you, which one do you like best? The daughter in the other room shouts, Mom, I need 12 months at least. And I told the agent, I'm like, they obviously wanted it from me. I was like, do the application, take care of the client. But it's because you got to know what actually happens and you got to share with them what actually will happen. And I go, it's not a bad idea to spend $250, Desiree, to protect $1 million in your house. Because here's what happens. Would you die, Desiree, and leave $1 million with Chase or Bank of America? She's like, absolutely not. I'm like, well, that's what you'll do in the home because nowhere does it say it's going to your kids. So what you have to do is put a policy in place like this so that they can go get the house, the equity in the house. Does that make sense? So cool. Anybody got anything else? Any other questions? Joy, it does, regardless if we use an IUL or a final expense, it's solely dependent on the client's health. Solely dependent on the client's health. If the client can qualify for an IUL, I'm using an IUL every time. If they can't because they had a heart attack 2 years ago, I'm using final expense because I have to. Yeah. Hopefully that makes sense, Joy. Because it's solely dependent, like life insurance is based on three things: age, health, and finance. So like they can want to buy an IUL all they want, but if their health doesn't allow them to, they can't get it. You know what I mean? But if they're healthy, most people that have homes earlier in age, they can. You know what I mean? So, let me scroll through and make sure I didn't miss anything. No, I'm thinking pretty good. Um, can we do a call like this for final expense leads? Absolutely. Cool. So, what's the rebuttal if they're like, I'm going to do a living trust and my kids make enough money because they have a successful job? They still, here's the best part. And Kim, this is where I become a little bit of a jerk, just a little bit. I go, hey, Kim, client, not Kim, because Kim is really nice. Hey, Mary, I was making $1 million a year when my mom died. I still didn't want to make two mortgage payments because you don't know what it is? I still got to bury her too. That was another 35 grand at least. Then I got to pay for probate. But in your case, you don't have to, which is awesome. But like, what are they going to do with the house? Are they going to live in it? Sell it? How are they going to get your belongings out? And by the way, most people, most of our clients, their homes are like in the threes to like 7/8s. So like very rarely do you see that. But if I did see that, I would tell them, I'm like, I made $1 million a year and I still had trouble doing this because this is the thing that people don't understand. And I would ask this question in the home. I go, Bob, you and Mary been married for how long? 42 years. Awesome. What's the secret, right? And I go, Mary, so like you've done almost everything in your life, your adult life with Bob. Yeah. Like y'all lived in this home together. Y'all raised your kids in this home together. Yeah. Okay, cool. He doesn't come home tomorrow. And then I go, what's it like? And she starts to stutter because they all do. And I go, and every room that you walk into, you have a fond memory of. And then I go, and what's the grieving going to take? Is it 6 months, 9 months, or a year, or maybe even longer? Because here's what I know: there is no timetable for grieving, dude. There isn't. Some people take a couple years to grieve. We had an agent. Her dad passed like 6 years ago, still struggling with it. You know what I mean? There's no timetable you can put on grieving. So how about we just don't botch this and lose the equity in the home and let the bank have it? How about we give her just enough time to figure out what she needs to do so that by the time she has to make the decision, it's where it's worn down. That's what I would tell people. Okay. Um, Once they pick an option, they want to go with, are you getting banking and social through the app or do you get it? I get it through the app. And like, I've never had trouble getting it. I don't know. Yeah, Daniel, I mean, I don't. Um, Hey, okay, I'm going to start an application with the insurance. It requires three things. Okay, cool. All right, sweet. So, hey, hopefully this helps. If you have any questions, feel free to reach out. But this is a fun sale. Like I tell people this all the time. Family First Life was built on mortgage protection and final expense for the first like 8 years the company started. This is the fun part of our sale because guess what? You usually get a husband and a wife. They both have jobs. The average premium is about $100 at least per app. That's like 2,500 per household. You know what I mean? Different lead, different clientele, pretty good for you. So hopefully this helps. I appreciate you guys. If you need anything, reach out and we'll get this posted on YouTube soon. All right. See you guys tomorrow.
Thank you so much.
Absolutely.